unit in Paris, Tennessee. So we have been operating this lending business while at the same time acquiring single families and multifamily properties. So that's me.
Thanks, Will. I just started up the recording there. So yeah, if you want to, I'll give you access to share your screen.
Okay.
Your presentation.
Let's get it pulled up.
So, I mean, you know, as we've been promoting this event, I kind of recalibrated my head a little bit. You know, this is, people see hard money loan, they're thinking like, okay, well, I'm not a fix and flipper, I don't need a hard money loan, so I don't need to attend this. But really, this is kind of from the perspective of the investor, right? And it's really a passive investment, you know, and Will's gonna talk about it, and this is why I invested in 6 of these fix and flips. You know, his team does a lot of the hard work for you, underwrites the deal, and you provide the capital. So he's going to talk about it in more detail.
Awesome. Yeah. Thanks again, Nick. So this is kind of our presentation for our fund. So about 90 days ago, we launched a debt fund where we are raising capital in a pool of capital and using that to lend out for these hard money loans. I'll touch on the story of the company. I'll touch on you know, the benefit to investors, why we like it, and things like that. But I'll put this in the back of you guys' head as well. Of this is very capable for you guys to do on one-off deals. So if you know any flippers or know any people that are buying real estate, it is very possible for you guys to lend to people you know in your network as well. So just something to think about. If investing into a fund or with us doesn't seem like the right fit, there's an option for that too. So I'll quickly touch on our founding team and our story. So I gave my intro, but the company really starts with Brandon. So Brandon Thornberry, if any of you guys know him, he is an awesome person, one of the best people I know. He started, he's been flipping houses in Nashville for about 15 years. So he's flipped over 100 houses in Nashville and currently owns a portfolio of about 30 to 40 houses and roughly around 400 units and apartments, and owns some commercial properties as well. So industrial and retail and things like that. And he's very much based just in the Nashville area in Middle Tennessee. And a few years ago, he found himself in a situation where he had more cash than he knew what to do with, or more cash than deals is probably a better way to phrase that. And so he came up with the idea of lending out his own cash to people who he knew in his network that were flipping houses. And he then quickly realized that there were more loan demand. There's much more loan demand for these types of short-term loans for flips than he even expected. So that's what I mean by I kind of got stumbled and got lucky with this opportunity. Of me and him were touching, or me and him were connecting on different business ideas, and I was trying to win his business as a multifamily broker. And he was telling me about this hard money, and he was like, "There's tons of demand for it, and it's a great investment option. I've lent out as much capital as I feel comfortable doing just with my own funds." And so he and I decided to partner and really scale and grow a business and build systems and raise capital. And literally, Nick was one of the first 3 or 4 investors that invested in some of our deals and really helped us get going just under 2 years ago. So again, we thank you for that, Nick. So that's Brandon. I touched on myself, and then we have brought in Logan Rankin as a partner as well. So if any of you don't know Logan, I would highly recommend checking him out on social media. Instagram is probably best. Just search Logan Rankin, you'll find him. He is an owner of just north of 2,500 units in multifamily, and he owns them 100% himself. And before working in real estate, he worked at a Fortune 500 company, and he was one of the top managerial roles at that company. So he's got a very good understanding and concept of how to scale a business, how to put people in the right place, how to manage a team. And so we've partnered with him strategically for 2 reasons. One is his advice and insight on scaling. But then secondly, as well, he's got a pretty large social media platform. So we leverage his network and social media platform in that regard. And then we have two other team members. So they're not on this presentation, but we have Sarah and Jonathan. So Sarah's our account manager. She helps close deals. And then Jonathan is one of our loan officers. So it's been fun growing the business. So that's us. And this will really be the meat of the presentation of why we think investing in hard money loans in Middle Tennessee is a great investment option. Before we do that, I do want to touch on our performance so far, what we've done in kind of the 2-year span. So far, within about a year and 10 months or so, we've lent out just over $23 million. Of that, we've raised just around 12 million because we can rotate the capital. So we've raised just around 12 million. We've lent out 23 million in total loan volume. And so far, year to date, we have paid $475,000 to our investors. And that's year to date paid distributions to investors. So it's been a wild ride for a couple of years, and we've really enjoyed it. So answering the question, why invest in hard money loans in Middle Tennessee? It's kind of funny. Of a year and a half ago or a year ago, when I was giving this similar presentation, I would say we're kind of in an economic environment where we think people are taking too much risk. And there's a podcast from me that I did with Dylan Marma, who spoke, a couple of times, one of the two of these events ago, where I was on the podcast, and that was my pitch of, I think people are taking too much risk. There's too many people throwing money into crypto. There's too many, the stocks, the stock market's going up way too quickly. There's too much bridge debt and on real estate. People are offering ridiculous prices on all different types of asset classes. And so we felt it was a good time to put money into a preservation of capital type investment. So take a slightly lower risk investment, but still make a pretty healthy return. So we thought it was a really good time to make a strong risk adjusted return investment. And now it's funny to see the environment now of everything seems to be going down. Real estate prices, housing prices, multifamily, stocks, crypto, almost everything is going down. So we're kind of seeing that prediction come true, and it still applies. Like now is still a time to put your capital into a preservation of capital type investment, rather than trying to take a ton of risk right now, until it's very obvious that we're bottoming out and interest rate. I mean, it really all just depends on the Fed. Until it's obvious that the Fed is no longer increasing interest rates or they're starting to pivot, it's still a great time to put capital into a really, really strong risk adjusted type investment. So the first thing that makes this a good preservation of capital investment is that we're first lien position. So when we make a loan, we hold the first lien on the property, meaning that if the borrower does not pay us back, we foreclose on the asset and we now own that property. So in the worst case and on the downside, we're very much protected, because worst case scenario, if we have to foreclose, we can either hold the property, fix it up, finish the renovations that the borrower was working on. And Brandon has flipped, again, north of 100 properties. So we have the in-house team to manage that. Sell it on the market, recoup the capital, and we're good. Or hold on to it. If we're not able to sell it for what our initial investment was, hold on to it as a rental and wait a couple of years. It'll cash flow in the meantime. And a house in Nashville or in Middle Tennessee is going to retain its value extremely well. So this is an investment that is protected against the downside very, very well, because it's a first lien position. And a good example is right now, a lot of people thought their 401ks or their retirement accounts were placed into a very low risk, risk adjusted return, and a lot of them may be, but I'm currently staying with my parents in Texas while I'm here for weddings, and I'm literally seeing them talk about how much, they want to pull out of the stock market because, it's supposed to be retirement. It's supposed to go up steadily, but it's just everything's so volatile right now. You don't want your capital in that type of a position currently. So the preservation of capital we think is huge. Being a first lien position, being extremely protected on the downside, is very important. And while multifamily and equity positions and mobile home parks, I also think are very good investments. The worst case scenario in those investments is that you lose all of your money. The bank forecloses on you and your investment goes to zero. Whereas worst case scenario in this investment, no matter what, you still own that asset if it goes to foreclosure. So I think that's just an important piece of it. The second piece of the preservation of capital is we're relatively low loan to value. So we typically like to be at about 75% of the after repair value. And as of August, I haven't looked in September, but in August, our average loan to value is about 68%. So chances are, if we foreclose, we're still in a very good position to recoup that capital. And I think I'm pretty sure I've touched on this, but I think it'll be relatively beneficial to talk about, just simplify what a hard money loan is when a borrower is flipping a house and they don't want to go to a bank, maybe they need to close quickly, or they want slightly higher leverage than the bank would give, or they have not great personal financial statement and they really need an asset lender. We're basically a private lender. So we're lending from our fund to them to help them flip the property, very, very simply. And we're really only in Middle Tennessee. So Nashville, Franklin, Murfreesboro, Clarksville, really just in this market where we're an expert on, and we don't go outside of Tennessee. We don't go too many other markets. So the second point of why we think investing in hard money loans in Middle Tennessee is a great option is what most first lien positions, most fixed income, and I hope we'll talk about this later, Nick, is typically it's very low returns. So typically it's 2, 3, 5% in that range. Obviously, right now, Nick's made it very aware to me that the 1-year Treasury and some of those risk-free returns are climbing, 4 or 5% or so. So you are seeing fixed income products increase, but for the majority of time, fixed income products, because they are lower risk, it's not a high yield. So the great thing about hard money loans is we lend our capital out at 12%. So we're lending to our borrowers at 12%, and then we're paying our investors 8 to 10%. So our investors are earning an 8 to 10% yield, which for a first lien position is extremely strong. So you get the benefit of the first lien position, you get the high yield. Additionally, it's a monthly cash flow. So we pay a monthly distribution through an 8% preferred return on the fund. So you're getting a monthly payment. And then we also offer a 90-day liquidity option. So you invest 100 grand. We do have a 6-month hold period, which I'll touch on quickly. But if you invest 100,000 after the 6-month hold period, you have the ability to withdraw your capital with a 90 days notice. So again, just touch on the points. Preservation of capital, first lien position. It's relatively high yielding compared to other fixed income products. You get monthly distributions and you have a liquidity option, so you can pull that capital out if you'd like to. And then lastly, it is really like any housing market, especially the single family housing market, it's very market dependent. It's very market driven. You want to be in a market that you know and feel very confident about. And we feel very confident in Nashville. It's been a growing market for a number of years. I don't have the chart pulled up, but if you look up like Nashville population trend, it's like it's just up and to the right. So it's a very strong population growth city. It's a beautiful city to be a part of. There's a joke that if you go to a bar, 50% of the people you talk to will have moved there in the last year. And anyone who's been to Nashville, if you meet someone who's like lived there for more than 5-10 years, you're meeting a unicorn, just because everyone has recently moved to Nashville. So very growing. And if you're familiar with Texas, I always refer to it as it's similar to Austin about 10-15 years ago, where it's a very culturally driven, very music oriented, very artistic driven city. So it has an incredible energy, incredible vibe, and people just love being there. And because of that, people are rushing to it, as well as, it's affordable from a tax perspective. The weather's great, the mountains are beautiful. So those are some of the non-numbers. Some of the numbers is 12.8% population growth since 2010. Oracle is currently building an office there, bringing 8,500 high salary paying jobs. Nashville, Amazon opened offices in 2021. They're finishing out their second tower in 2023. That's bringing, I think it was 5,000 high paying jobs. And it's pretty common for me to go to like the Nashville baseball team game and run into people that work at Amazon. So it's very much a music city, but also a high paying tech industry as well. So there's a ton of growth in terms of population as well as jobs. And then the markets around Nashville are also extremely strong. So Murfreesboro, Clarksville, Columbia, Franklin, Chattanooga. These are markets that Brandon owns real estate in. I'm a partner in a 36 unit in Columbia, Tennessee, which you can see down at the bottom of the screen. So
we love that deal.
Yeah, it's a great deal.
Good deal.
Yeah, the Cosgrovians. But the Nashville's a strong market, and it's got a ton of surrounding markets. And like you can see Columbia here. Mike Taravella, who's the GP on this deal, he always jokes that he's like, it's all the market. Like we just got lucky in terms of the market we picked, and that's a case of market research. And that's from this chart that looks very rural. But think about the cities that are, or the areas right around Nashville. I mean, it's just an incredibly strong market. So should I pause for questions, Nick, or should I just keep going and we'll get?
Yeah, we can pause for questions.
Okay.
Any questions?
Take a couple questions. Or I can keep rolling.
I have a quick question.
Yeah.
So are the property types still what you would find in like commercial property settings? Is this just the type of loan that's changing? Or are we still talking about commercial real estate and residential units with multi-unit properties?
Yeah, so that's a great question, and it actually ties in perfectly to this next slide of it says our loan products. So 90% of what we're lending on is single family houses. So we're lending to people who are purchasing single family houses, renovating and selling them or refinancing them. We also do we've done a handful of duplexes, triplexes. We've done a couple commercial deals, but we've really just kind of found a niche in the single family flips that's 90% of what we do. We've done a couple larger industrial and commercial loans. We did a $3.7 million loan on an old warehouse, but the majority of what we're doing is single family flips.
Okay, thank you.
Yeah, thank you.
Now, Will, I was just going to add, your previous slide, one of the things I really like about these loans is, as an investor, if you're an investor, you have to maintain capital, escrow, hard money, as you're hunting for deals. And these things are so short term, potentially, depending how long the term is, it just allows you to earn some yield while you're waiting for these deals to come. And you can kind of time out when you do these things and when you have deals in contract. So it could be, a person that's an active investor. It could be a person that's just invested passively in deals as an LP, as a syndicator. They just kind of want to diversify their portfolio.
Yeah, absolutely. And so I should have mentioned this at the beginning, but we have two kind of investment products. So we have our debt fund, which, that's really what we're pushing towards because it's just a scalable model. And that's where we pay the 8% preferred return. We also sometimes will fund loans individually. So if all the capital in our fund is completely deployed, we will send out loans to our investor list of just an individual loan that says, hey, here's a $200,000 loan or a $100,000 loan. It's a 90-day term. Does anyone have an interest in funding this? And so we offer those as well. Those are becoming more and more rare as the fund grows. we're able to fund most of our deals through the fund. But on those deals, we'll actually pay a 10% return just because your capital's more dialed into one investment. And we found that the busy W-2 income earner or the retired 401k investor, they want to be in the fund. They want the consistent returns, the monthly distribution, and they want to leave it there. Whereas a lot of the real estate investors, like people like yourself, Nick, they want to be involved in the deal. They want to know the deal. They're kind of like a deal junkie. They want in and out versus the consistent cash flow. And it's a quick joke on that is I was talking to the two guys that were investing as kind of in tandem, and they funded a deal. It paid off, and I was like, "Hey, we've got another one if you're interested." And I was like, and they're like, "Yeah, just hold on to the capital and we'll fund it." And they're like, "Man, I wish we could just leave the funds with you." I was like, "Come on, like we literally have that." But some people just like the deal to deal, versus some people like to be passive completely. And what's cool is we have both options.
But
So
even when you do deal by deal, you guys will send out a Loom video, talk about all the sale comps, talk about this specific submarket, and fully underwrite the deal, and and tell, it's kind of like presenting. When I worked at Nuveen, you have a deal committee. You have to present the deal to the deal committee. You're presenting it to your investment committee, your investors. So you make it really kind of easy to latch onto these things, because one of your value adds is that you can really move quickly, because versus a bank, right? That's kind of the value add to your fix and flip guys.
Yeah, absolutely. And those videos, our investors have really loved just seeing, being involved in the deal and seeing the full underwriting on the deal. And my experience at the commercial bank was very helpful, because that what I used to do was underwriting. So quickly, I'll touch on the loan products that we offer. So what type of loans are we lending out on? So the first one, the most popular one, is a single family fix and flip loan. So this is someone who's purchasing a property, a 3-bed, 2-bath, 1,200 square foot single family property. They're purchasing it at $150,000. They're going to put $30,000 worth of work in it and then sell it for $300,000. So we fund up to 100% of purchase price. We don't fund any rehab. So we ask the borrowers to bring the rehab funds, which is pretty rare, actually. Typically, lenders will do that. So we're lower leverage than most lenders. So we'll go up to 100% of purchase price, limited to 75% of their sales value, no rehab funds, and then we'll be in a 1 to 6 month term. So our longest loan term is 6 months. And then another popular one we have is a land acquisition loan. So if someone is purchasing land and they want to close quickly, a bank may take 30, 60 days to close a land loan. Whereas a lot of times what borrowers will do is they'll use our capital to purchase the land, and they already have their bank loan lined up. And we'll talk to the bank loan, and we'll talk to the bank lender and say, "Hey, have you guys vetted this deal? Have you guys vetted the borrower?" And they go, "Yes, we're excited about it. We just need 60 days." And the borrower will close on the land with our capital, and then 60 days later they'll refinance us out. So we love that stuff. A quick 60-day loan, and Nick loves those quick loans as well. And then the last one, this is the rarest one, but it's the best one, is transactional funding. So this is when someone just needs capital for 24 to 48 hours. And a good example of this is wholesalers. So if someone's purchasing a property on Monday at 100,000, and then they're going to sell it to someone else on Tuesday at 125,000, a lot of times what people will do is they'll use our capital to purchase it, and then a day later they'll turn around and sell it. And the benefit to the wholesaler is they don't have to disclose to the end buyer how much they bought it for. So the end buyer thinks they're just buying it at 125. They don't know that the wholesaler just bought it at 100,000 or 125, whatever number I was using. So we love that stuff because we can almost make it risk-free. We can not release our funds until the other funds come in. So that the transactional stuff is what we love. So in the fund and on the individual deals, these are the type of loans we're doing. And these are a couple sentences we always repeat to ourselves are, would we buy this property at the loan amount we're making? So if we're underwriting a deal and we have certain metrics we look at, certain things we check on, plumbing, electrical, we have a full underwriting process. But if we can't decide, a question we love is, would we want to own this property at the loan amount we're making? And with Brandon's experience owning and renovating properties and flipping houses, if he's even like, I don't know, we go, okay, we're not going to do it. And then there's another one, good properties, great location, first-class borrowers. So if the deal checks these things, we feel very confident in it. And just quickly, I'll touch on the fund terms. I do kind of want to talk about market conditions and get everyone's thoughts and questions there. But so the fund terms, it's evergreen fund. It's an 8% monthly distribution, 90-day liquidity option. Our minimum investment is 100,000, and then it's a 506c offering, meaning you do have to be accredited investor to invest. I think those rules are silly, but it is what it is. And then a couple things to note is we launched the fund in July. We are holding the distributions for the first 8 months of the fund, so your interest will accrue. But on March 2023, you'll receive all the accrued interest and then monthly distributions after that. With it being our first fund, first 8 months, we just thought it best to kind of hold the capital to make sure. We do have a 6-month hold period, which I mentioned, and then you can withdraw your capital after that with 90 days notice, and no management fee. So again, it's our first fund. We paid for all the legal costs to get this set up, and we're not charging a management fee. So we don't make any money until we hit our preferred return. And we don't get recouped for our legal costs or anything like that. We just thought, this being our first go around, it'd be a good way to do it. And then this is an example of, if you invest 100,000, this is what your monthly distribution will look like. If you invest 250,000, this would be what your monthly distribution looks like. And again, we've really found that the high W-2 income earners, or the people that just want to place 100, 200,000 and be very passive and just receive the cash flow, they really enjoy this stuff. So I wanted to put my email and contact information here. I do have to put a disclaimer. So if you want to read all this, you're welcome to, but this is not a direct solicitation, and I'm not making any guarantees. It's still an investment at the end of the day. My attorney wants us to do that. So I'll take questions, and I would love to touch on kind of like market conditions and things like that, so maybe Nick, you can have that question there. But I did want to ask if anyone is interested in being added to our investor list. So we have an investor list. We send out monthly updates and videos on the fund, as well as we send out individual loans that we are looking to fund. So individual opportunities as well as updates on the fund. If you guys could put your email addresses in the chat, as we're talking and networking, I will copy those and add them to our investor list. Unless, Nick, you think there's a better way to do that, but yeah. So
yeah, I think that works.
Cool, awesome. Thanks for listening. I might have been a little short, but I like to keep it short and sweet.
That was great, Will. Thank you. Yeah, I mean, I think the first thing that pops into my head, going through, recession is coming. Fed, I think, is going to just continue to aggressively increase rates until they start seeing inflation come down for a bunch of months. So the markets are going to continue to get hammered. How are you kind of mitigating the risk of that? Fix and flippers, buying stuff, defaulting on loans. Like, how are you? What kind of defensive measures are you taking in your kind of new loans you're issuing?
Yeah. So
coming.
The first answer to that, I've got a couple notes on that, but the first answer to that is, we've been conservative from the beginning. Like, genuinely, 2 years ago, I was like, the mother of all crashes is coming. I just don't know when. And I remember telling my parents, like, I've kind of given up on trying to prepare for or plan, or I've given up on trying to guess when it's coming. I'm just building my portfolio for expecting it to come. So we've been conservative from the beginning. And a lot of that is our loans have been very low leverage. It's with borrowers, for example, that we have seen their bank statements and we know that they have the capability to pay us off in cash if they really need to, or we're really confident in their exit plan, whether it's a refinance or a sale, that if they need to drop the price 20%, they're still able to pay us back as well as they're still able to make money. So that question of would we want to own this property if we had to foreclose on it has really guided us. And it's caused us to be, a year and a half ago, probably like some borrowers would call me crazy that we're way too conservative. But now it's really been a guiding light for us, and it's been very good. The second piece is we're only in a market that we know. So we're not branching out to a bunch of different markets. We're not going to rural areas. We're really staying in central MSAs and markets that have a strong buyer pool, that have a ton of demand, that have a growing population. So just a strong reliance and belief on Nashville as a market. And then thirdly, and this is one of my, like, I didn't think about this, but it's one of the cool things about hard money loans that we've kind of naturally found, is that we're able to move with the market. So an example would be a $200,000 loan we made 8 months ago. If it paid off a month ago, we have the capital back and we can redeploy it based off today's numbers. So we can look at comps that, we can look at houses that sold in the last week and say, okay, the house just sold in the last couple of weeks at this amount. So we're going to base our loan based off the most recent comp. So we can kind of be fluid and move with the market. And it really, while yes, there is a realistic scenario that, the floor could drop and none of these houses can sell. And as a manager, we have to think of those options. Again, we're protected by the downside of the foreclosure and renting out, but it makes me feel like we can mitigate our risk a lot. Of if we have $1 million that we're lending out, we can make decisions based off how the market moves. So loans we're doing 6 months ago pay off, and now we're lending again today based off today's metrics. So the short term allows us to really move with the market based off today's comps. And that's, I didn't think of that moving into it, but it has been really cool to see.
Thanks, Will.
Hey, Will, this is Mike. Could you bring up the slide presentation again and go to the 3 different products? I had a question about something I saw there.
Yes. Can you see this here?
Yep.
Okay.
Yeah, this slide.
Right.
This is it. Yeah. So what's the ARV? I know I've seen that. I'm more of a commercial guy, not a residential guy. I feel like I've seen that on fix and flip stuff before. What was that?
Yeah, it's after repair value. So if they bought it 100,000, they're putting $50,000 into it, and they expect to sell it for 200,000. The ARV is that 200,000. So it's what they expect to sell it for after the renovation.
Okay, so you'll fund like the full purchase price potentially, but then only sell it to 85%. And then so how do you what does the underwriting process look like for this? Like, I was a commercial underwriter for multifamily, so it's obviously based off of like cash flow and that kind of stuff. What does that process look like for a single family home flip?
Yeah, so a big difference between single family and multifamily, for better or for worse, is that single families are pretty much solely based off comps. So they're based off what things are selling for recently in the area, whereas multifamily is based off of a multiple of your NOI and your projected expenses and things like that. So the underwriting process is actually like one of the things I'm most proud of. I was an underwriter at commercial real estate bank as well. So we get on the phone call with the borrower, we ask about the deal, we talk through the deal, we go through it, we ask for pictures, we ask for comps, renovation budget. And then what we'll do is me and then Jonathan, who's our loan officer, we'll underwrite the deal together, we'll chat through it, we'll make decisions, and then we'll create a loan presentation. So it's like a 10 to 15 minute video where we go through the entirety of the deal. So here's what the property looks like. Here's its physical issues. Here's the renovation budget. Here's how much they're putting into it. Here's the comps. Here's the borrower's credit score. Here's the bank statements. And we send that video to Brandon. And Brandon, who is, technically our chief credit officer, so he makes all lending decisions and approvals. And he's flipped north of 100 houses. So his expertise on the decision making is really invaluable. So he knows all different things like codes and setbacks and flood maps and the cost to renovate a property. Yeah, it's not uncommon for him to be like, oh yeah, I used to own the property down the road. So I was a credit analyst underwriter at a bank for 2 years, and then Brandon's understanding of doing these himself has really blended together quite well. But that was a long-winded answer, but I think directly answer you, it's really just our experience of renovation, and then also looking at very recent comps of what things are selling for.
And have you seen the market shift in the last several months? Like, I think I was looking at, and actually it's funny because I actually used to live in Nashville for 4 years myself, so I know the area pretty well. But I think prices have started to soften a little bit, it seems like, but nothing too crazy. So what are your exit prices? Like, do you guys kind of track what you estimated it for, like to sell at, and then see where they have been? I mean, I imagine probably outsold everything you've projected so far. I feel like the next 6 months will probably be a little more telling, given that the market's not just going straight up anymore.
Yeah. The euphoria is definitely gone. There's a direct quote I said to a borrower. I was like, I can't underwrite euphoria, But yes, I would say we've probably seen a 10% discount on sales prices across the board. And when we underwrite deals, we look at, okay, if they have to sell it for 20% less than what they're thinking, do they still make money? And that's kind of our telltale sign. So we've certainly seen houses sitting on the market longer. We've certainly seen things that used to sell immediately sit on the market much longer and need a discount to be sold. So I'd say on average we're seeing a 5 to 10% discount on sale of houses. And I'm a big believer in, as long as the cost of capital is going up, the value of housing and any asset classes are going to come down. So as long as the Fed is increasing interest rates, we're going to continue to see valuations come down. I think it's just kind of like simple math. The one thing to note is that there's still buyers. Like, we saw a house listed on the market and sold, or was put under contract and sold within like 30 days. But the buyers, so there's still a strong buyer pool, but the buyer pools are much pickier. So they want the 3-bed, 2-bath. They want an open kitchen. They want the renovation to be done well. They want it to be in a good location. They're not, the buyer pool is no longer desperate. They're not going to, buy a 3-bed, 1-bath because they've bid on 10 3-bed, 2-baths. They're going to have a choice between a few properties. And so they're much pickier, and they're really, value is very important now, like a quality renovation, a quality property, and quality location. Those types of properties are still selling strong and still hitting ARVs that our borrowers are expecting. But it's the 3-bed, 1-baths. It's the half-assed renovation and not a great location. Those are the ones that are struggling, I'd say.
Gotcha.
Hey, Will, I was just going to mention, when it comes to underwriting, as a guy that did a hard money loan with you, works for as a lender, commercial lender, multifamily, and when he was underwriting it, obviously the numbers were important, but he had a lot of questions about who was doing the fix and flips, right? The people were like really important to him. So,
That's
I
how you
mean,
know he's a lender.
yeah, like, so to me, like, this is where, your team really adds value. That, the fact that Brandon has done business with a lot of these guys and put his own money at risk with these guys and has a track record. And the character of you and Brandon, some people call Brandon like the nicest guy in the world.
Yeah, I said that a few times. Yeah.
Yeah. People's character, especially through a downturn when things can potentially go to shit, like people really show their true colors when things don't go well. So I think that's just, indicative of you guys, but it was interesting, like what he focused on as a lender.
Yeah. And that's really why our saying here is good properties, great location, first class borrowers. Like we do put a ton of emphasis on the borrower's financial position, their experience, and then also their integrity. Like we have a live Excel spreadsheet it's a do not lend list with a bunch of other lenders in Nashville. So that's, we check that on almost every new borrower. And yeah, we put a lot of emphasis on, high quality borrowers. Absolutely.
Hey, Will, I have a question.
Yeah.
This is Matt. So can you go into a little more detail strategically about why you do not provide rehab funds? It seems kind of unique among hard money lenders that I've worked with. I understand not wanting to limit your exposure to leverage, but you could have taken the approach to do 75% of the purchase price plus rehab funds up to 75% of the ARV or some other variation of that.
Yeah, the main reason is a little selfish. We don't want to deal with inspection draws or having to go out and check the property and send a construction draw. It just kind of from an operation standpoint, we find it to be extremely simple if we just fund the majority of the purchase price and don't deal with the rehab. So that's really the main reason. But then also we like it because it keeps us overall low leverage. And I see what you're saying, where we could keep the similar leverage and have them put the capital down at purchase. But one of the things our borrowers really like is that at closing, they don't have to bring any, they're bringing almost just closing cost at closing, and then their skin in the game is the renovation. And I feel like that aligns the incentives of they're using their own funds to turn these deals. So they really want to be effective with their capital rather than using a bank's capital. But the real answer is just from an operations standpoint, we found it simpler if we just don't deal with the rehab process at all. And we've got enough demand. We've definitely lost out on deals because we're not doing renovation funds, but we have enough demand where we haven't been forced to do that yet.
Yeah, it's interesting. Is Tennessee a deed in lieu of foreclosure state?
I don't know the specific answer to that question. We've not had to go through a foreclosure.
How many loans have you done?
We've done about 90, just north of 90 loans.
Oh, that's great.
Yeah.
What's your average loan size?
I don't know the exact number, but I'd guess around 200,000. And to go back to the deed in lieu of foreclosure, I don't know if it's a yes or no question, but we can do a foreclosure and we also can do a deed in lieu of foreclosure. So I know we have the capability of doing both, but I don't know if. So I would assume we are a deed in lieu of foreclosure state if we have the capability. Do you know?
Yeah.
Okay, then yes.
Do you have to, or are your loans recourse? You've talked about taking foreclosure, but have any of them paid off? Have you had to go after your borrowers? So
yeah, we knock on wood, to date, we have not had any foreclosures. So we've not needed to foreclose, and all of our borrowers have been able to pay us back. But we do require a personal guarantee, and we have a foreclosure attorney on retainer, and that's the same attorney that drafted our loan documents. So our loan documents were drafted by our foreclosure attorney, and he used the metaphor that I'll use of, you want the cook to buy the groceries so that they can't complain about the groceries when it's time to make the meal. So, yeah, we have a foreclosure attorney on retainer. We do require a personal guarantee, and we've not had to go through with that to date, knock on wood again.
And if you've done 90 deals, how many applications have you gone through? What's your hit rate?
Define what you mean by hit rate.
How many applications have you taken and how many have you turned down compared to
Okay.
done?
Yeah, so I don't know the exact number on that. It's not something we track. I'd say we turn down 25% of the deals that come in. We turn down a pretty healthy amount of loans.
It's like your deal pipeline.
Yeah. Yep. So y'all are giving me stuff to research. I like it.
Roughly, like what percentage would you say are repeat sponsors?
Most of our borrowers are repeat. So what we really like about the hard money lending stuff is that if you find a good fix and flipper, they're typically doing 2 to 5 of these a month. So one good borrower is going to come back to you 2 to 5 times a month, so that they can keep you busy. So we probably have 7 to 15 borrowers that are doing 2 to 3 loans with us a month, and that really keeps us busy. So in total, we probably have less than 30 borrowers that we've lent to, and a lot of it is just repeat business. And I think it's really because we are extremely efficient to work with, and I think our borrowers really like that.
And what was the total amount of capital you've raised just throughout, both from the fund and the different I guess transactional loans?
It's let's see. Just about 13.9 million.
Okay.
Yep. So we launched the
total volume of loans that you've made. What's your turnover then?
Yeah, we've lent 23 million.
So not quite 2 times.
Yeah, just under 2 times. Yep.
So this was a question, it sounds like Nick has been asking you, but I want to ask you directly. So are
Yeah.
you guys thinking about raising rates, given that the Fed has raised rates?
And have
raising
you thought
return?
about taking an equity kicker on your deals?
There we go.
So equity, yeah. So I answered both. I'll go with the latter because it's a little quicker. On some deals we have taken an equity kicker. We don't do that through the fund just because our loan docs don't allow for that. But on individual deals, we have chosen to partake in the upside, and those are one of the investments that we would capital raise for outside of the fund. It'd be an individual investment, and typically the only time we take an equity kicker is if it's a higher risk deal. We'll say like, hey, we wouldn't want to do this. The only way we would do it is if you gave us a percentage of the upside, and we'd want to partner with an investor on that, and that would be outside of the fund. So
you limit like the loan to the amount you're comfortable with on the loan, and then the equity would be kind of on the outside.
Yes, exactly.
Yeah.
So our loan terms are
You don't want to
typically,
do the deal, but if it's riskier, you would take an equity position.
yeah, it's kind of like if we're going to take a higher percentage of risk, we need a higher upside, and we would want to partner with an investor that's up for that. So some people have a higher motivation for risk, and me and Brandon tend to have a very low appetite for risk. So it's kind of
That's why you're a lender.
Yeah. I'm always thinking about what's the worst case scenario, but it's exactly right. If we're taking a higher risk, we want a higher return. And then, so on the,
I would try to get an equity kicker on the lower risk deals too, but that's just me thinking.
yeah, I mean,
Good question, Nick. Are you approve?
Do what? I'm sorry.
Nick, do you approve of the questions? What do you think?
Oh yeah, go for it. I told him Steve and I know each other from one of my W-2s, and I said, Steve is a veteran and knows a lot, and you're going to get zingers. And Will said, bring it up.
Oh, okay. This is that Steven. All right.
Steve's the guy.
I like it. I told Nick, I was like, tell him to give me the hard ones. Bring it on. But yeah, I mean, the flip side of that, Steven, is that we want our borrowers to love working with us. So I get what you mean of it's better if you can get a lower risk and take a percentage of the equity. And there are some deals where we make $3,000 and our borrowers make $40,000, and it hurts to look at a little bit. But our borrowers walk away saying, you know, man, that was awesome. So we try and
43.
do what?
I guess they do walk away thinking that's awesome if they get 40-3.
Yeah. I mean, that's not always the case. There are some times where I look at it and I'm like, man, they made a lot more than we did. But it's kind of the name of the game. It's a volume business. But yes, we have on like, I'd say like 4 or 5 deals, we've structured an equity position in it. So on the interest rate question, Nick, and I think was it Michael that asked the question?
Yeah, Mike.
I'm a little bit torn. So I guess my thought is we're in an environment where most things are going down. Most investments are going down. So if we're able to hit a consistent 8% return, that's strong. Whereas in an environment where most things are going down. However, I completely understand the flip side of you have a risk-free rate at 4%. Like, so it may make more sense to go in that direction. So it's something we're thinking about often of, does it make sense to increase the interest rate that we're paying to our investors, as well as the interest rate that we're lending our funds out? So like, should we increase our interest rate to 14% rather than 12, and then pay our investors 9 to 10%? It's something we're certainly thinking about and considering, but at this point, we have been able to raise enough capital at the rates that we're raising, and so we've still been able to attract enough capital that we're not forced to increase our interest rates, and our borrowers still love using our products. And our competition hasn't really raised rates too much in terms of what they're lending out at. So we're watching our competition in terms of lending, and then we're keeping a feeler on what we have to, promise to our investors to raise. So as of right now, I still feel that an 8% return is strong, especially in an environment where most asset classes are going down. However, if the risk-free rate is 5%, it's going to be hard to convince capital to invest with us. So it's just kind of a supply and demand, what we're forced to do almost.
Yeah, that's a big part of it. If you're the guys you're competing with on loans, they're not increasing their rates. You should just keep your borrowers happy. But as an investor, I'm like, increase those rates.
And to be fair, you've been saying that for like 4 or 5 months now.
Yes, I have.
Yeah.
But yeah, I'm sure you're monitoring the market, what your competitors are doing, and so totally get it. But yeah, risk-free rate is basically 4 right now. So yeah.
I got a quick question. Will, good to see you, man. Thanks for the chat.
Hey, what's up, Scott?
How we doing? So just curious about, the 506C. Was that a requirement to set up the fund, or like what was the reason that you set it up with that requirement?
So really, in order to do in order to actively advertise the fund, you have to do a 506C. You can do a 506B, but you can't publicly advertise. So we made the decision that we wanted to publicly advertise the fund, whether on social media or presentations like this. And because of that, we chose to do a 506C, which it does limit us to accredited investors only. And I think those rules are, insane, but it's purely just so that we can market publicly without having to worry about, like, we didn't want to be on podcasts and saying the wrong things and things like that.
Yeah, that makes sense. So, and that is kind of like a newbie question, so appreciate you humoring me.
Yeah.
But like, if somebody comes into your website inbound, like let's say, they're typing hard money loans Nashville and they hit your website, like, do they fall under that accreditation process, or like you can still loan to them, like even if they weren't accredited, correct? I'm sorry.
Yeah,
they still invest in your fund even if you weren't accredited, right?
So for anyone to invest in the fund, they would have to qualify as accredited investor.
Okay.
Yeah, and it doesn't matter how they found us or anything like that. There are different rules.
Are your single loan deals required accredited investor?
They're not, because it's more of a partnership rather than
Okay, so to answer Scott's question, someone inbound can say, hey, I'm interested in this and invest in one of your single deals.
Yeah, so okay, so now I get it. So it's like the fund is very specific to accredited investors. You'll still take investors' money that aren't accredited, but it wouldn't be as part of this fund pool. Is that
correct?
Right?
Yeah, that would be if we wanted to partner on a deal, or if we want to fund an individual deal. That would work for that. Yes. I apologize. I'm adding these emails in. So okay. Cool. Steven, give me some more hard ones. What do you got?
I'm just wondering, how do you verify the accreditation of the investor?
Yeah, so we there's a handful of ways you can do it. So accredited investor means that you have a net worth of $1 million less your personal residence, or an income over the past 2 years of 200,000. If you're married, it's 300,000. So we can do tax returns. So they can send over tax returns to verify income, or a signed letter from a CPA, attorney, or I believe like your financial advisor stating that they have verified the personal assets to qualify. And typically a signed letter from the CPA is what most people do.
What's going to bring your business to a screeching halt?
That's a great question. If I died, that would do it. The worst case scenario, the worst case scenario would obviously be if interest rates go high enough that the buyer pool is completely wiped out. So if no one can afford a mortgage because interest rates are 15-20%, that would be the worst case scenario. And in that scenario, we would foreclose on a lot of our borrowers, or we would modify our loans and extend their maturity dates. So it would be one of those two, probably a combination of both, where we'd foreclose on a good majority, or extend the maturities. And if we foreclose on a large majority, we would turn those into rentals and hold them until it's long enough to sell them. And then the modifications and extend the maturities, that would be on a case-by-case basis. So this business is set up to be very well protected on the downside, but that would be the worst case scenario if interest rates go 10, 15, 20% and the buyer pool just completely disappears, meaning no one's buying houses. That's a good question, though. I like that.
Any other questions, guys?
I know you're focused on Nashville. Any secondary locations you might consider?
So really the only secondary market we'd look at would be Knoxville. We've done maybe 3 or 4 loans in Knoxville, and it's really only with borrowers that we know well. And I guess we have done some in like Bristol, Kingsport, so East Tennessee. But again, that was with a borrower that we were very comfortable with. So East Tennessee, Knoxville, Bristol, that we would consider those markets as well.
Have you thought about other markets?
Yes. I mean, I think we would expand to Texas as a state next and focus on DFW, but I think that's 2 years away.
Mm-hmm.
What's your target volume for the coming year? We're coming up the end of this year.
Yeah, that's a good question. We right now we aim to do 5 million a quarter. So, 20 million.
Okay. You got an interesting model here. It's intriguing.
I appreciate it, Stephen. Did you put your email in?
Yeah, I did.
Oh, okay. Okay, I see it. Gotcha.
But every time I hit the return key, it just sets up another one.
Great.
Hey.
Well, yeah, we'll release our monthly update here soon, so
Right.
I'll head your way.
Awesome.
All right.
Any other questions? It looks like Scott had some. Linda, Lindsay, Sally.
I got my mom on. She's downstairs.
Good support. Her son, that's good.
She's an investor. I tell people my parents are invested in the fund as well.
Nick, what's your next topic on CRE mastery?
That's a good question. It might be build to rent. So we're still figuring that out. I mean, honestly, like the investment markets right now, everyone is just like, some brokers are like not even doing deals to the end of the year, multifamily guys, because the market is so crazy. The capital markets are so kind of a little crazy. So our last meetup wasn't that as well attended as it typically is. We usually get like 40, 50 people. And I think people are just like on the sidelines. It's harder to raise capital right now. That's why it's impressive that you raised for your fund.
Yeah.
There's really big name syndicators right now that have a huge social media presence, like on Twitter. They could raise like 20 million, $200 million through their social media presence, and they're not able to raise capital right now. So yeah, it's just kind of an interesting time. It's a good time to learn about other property types, because I think multifamilies. I talked to someone last night that bought a multifamily property in December, bridge debt, didn't get an interest rate cap, and they're selling the property now at like a 30% discount.
Jesus.
Yeah. So, these people that bought on bridge debt, even with an interest rate cap, they didn't underwrite these interest rates. They're gonna be in trouble. There's a lot of newbie multifamily people. So we're monitoring, CMBS to kind of see what kind of distress there is in the market, kind of high level, but even at detail level, see if if there's going to be more deals like that coming along, I think.
Yeah, that bridge debt stuff is scary.
I mean, that's why my partner Mike was a lender. He's always thinking the downside. Like we never looked at bridge debt. It was always fixed rate debt or loan assumptions. That was it. But yeah, Stephen, to answer your question, you'll see on social media whatever topic we come up with, we'll push it out there.
Sounds cool. All right, I got to go. Will, thanks for your time. Appreciate it.
Thank you, Stephen. Appreciate chatting.
So long, Nick. We'll talk soon.
See you.
Thanks, guys, for letting me crash your Zoom and hear what's going on.
Yeah, I didn't see.
Thanks for joining. Do you have any questions? Okay.
No, it was interesting. It was interesting I saw the topic and was like, I want to hear what Will's doing.
Yeah, I wish I saw you at the beginning, but yeah, thanks for tuning in.